Get Rich Slow with John Wolf. Hey, today I want to talk to you about the basics of mortgage pricing and what has happened to mortgage pricing throughout this last year and where I expect things to go. And to do that, I'm going to have to spend a little bit of time explaining what the basis of mortgage pricing for you is and what the market, it's actually the bond market in this case, not the stock market, has been doing and how it relates to your mortgage loan prices. Okay, so first off, it's important for you to understand that once your mortgage is made, it becomes a sellable financial security instrument. So the real bottom line for the total pricing of what your interest rate is going to be is based on how much I can sell that for. If hopefully that makes sense. So I'm going to be showing you now a graph of the last few months for mortgage-backed security bonds, and this is the 2% bond. And just take a few minutes to look at it while I talk. So what actually goes into the pricing? There's really three places the mortgage company makes money selling your mortgage because it can kind of get sliced up. So one of the slices is on the origination. So basically, there is a set amount of interest rate higher than the bond that you're going to be charged. And then that money is going in two places. One of those places is profit for the mortgage company itself, and that profit is set against the cost of actually making your loan and absorbing all or almost all of the risk of your loan, because the final instrument, the bond, is actually super safe and insured and a super not risky investment. So that higher bit of the interest rate is used by the mortgage lender and then the mortgage servicer to mitigate risk. That brings me on to the second point. There is the mortgage servicer. So the rights to service your loan can be sold separately from the actual loan or the bond for the loan itself. And typically, although this is by no means a rule, servicers make 0.3% of the balance of that loan per year for doing the work of servicing. So if they can keep their costs low, that's great, but they're actually responsible for making the payments along to the investor, even if the client doesn't. So it's not by any means a risk-free proposition for them. And then the last place is selling the mortgage-backed security itself. And that's why I have you looking at this graph. The last couple months have seen the absolute lowest mortgage-backed security bond prices that I have ever seen. So basically there is on this graph, from where you see the high point to the low point at the most recent date, there's a difference of roughly $230 per $100,000 that you would borrow. And that's really the best way of thinking about it too. I know that I have another video comparing rates and points, and this is sort of the basis for that system. What it really says, what that graph is really telling you is if you want to go buy a 2% bond, then back at the high point in that graph, you would expect to pay $104 in order to get a $100 bond. Now, obviously the bonds are much larger than that, and then in the most recent date, you would expect to pay something like $101.70 for that same $100 bond. And this relates really directly to mortgage prices because this is where the money goes after your loan is made by the lender. So let's just step back and take a look at what the mortgage pricings for this last year have been. So here is a zoomed out graph. It's a little bit hard to read because it's so small, but it starts in February of 2020, before much of anybody was worried about the whole COVID thing. And you see it's at a very, I didn't continue the graph, but it's basically a straight line sloping up, downward actually, in the area before you see it. And then it's basically a straight line. And then what went on is the demand for the 2% mortgage bonds and their really existence went up considerably. So people started to pay more for those. And then you see a crash, and then you see a steadily going up. Then it's been leveled off, and now it's going down. And one thing I need to explain right now, because it might seem weird to you that the down is red and the green is up. If you're the person who's actually going to get a mortgage loan, down is bad, up is good. Because again, this isn't your interest rate. This is how much the lender can sell your mortgage-backed security for. So let's zoom into the section that includes the sort of the zoom in of the kind of market panic and shift that happened with the COVID. So now we're looking at from the start of 2020, basically through the end of April. It's just start of May. And what you see is it's pretty flat, like I said. And then what happened when you see that going up is a pretty natural market force. So what's going on there is people, airline companies were just starting to realize they were going to have to shutter stuff. People in the stock market realized there was going to be impact to the economy. And those mutual funds, those institutional buyers who do giant retirement funds, they realized like, oh, no, what the heck? I am going to have to figure out something to do with my money, because they have to buy stuff every week as people put into the retirement fund every day, every week. So the stock market looked down. So they're like, hey, stocks are risky. I'm going bonds. And that makes the bond market go up. And about a week and a half later, the people buying the mortgage bonds instead of stocks realized like, hey, wait a second. If everybody's getting laid off or furloughed, how are people going to be making their mortgage payments? So then you just see that crater down. And at that point, or actually even during the crater, the Treasury and the Federal Reserve basically made this not really a free market. They just said like, hey, we're going to buy all the bonds, all of them, and we're going to keep buying bonds until the price of the bonds is increased. And they didn't say these actual words, but to the level where it basically is going to make sense for everybody in America to be refinancing. And people can easily buy homes at a higher price than they were before. And that's really what you're seeing there. Now, I just want to go back to the recent time period. So this is like November through when I'm shooting this video, which is February 20th. It's business days only, if you notice the dates kind of jump. But anyways, so they're the best mortgage prices we have ever had were back the very first week of January. And you can see that. So when I was like looking to quote people, just the, honest, no BS, no points quote for good credit purchase conventionals, it was getting down to like 2.5. And if somebody wanted to do 2.75, I was going to be able to give them like a huge lender credit. So it might cover all of their closing costs. And the same thing for refinances, ensuring it's a little bit more expensive. So it was something more like at 2.75, they could have still a huge credit, probably cover all those closing costs because refi closing costs are less. Or they could have like 2.625. And you've seen that from that graph that the actual cost of borrowing that money increased a bunch. So unfortunately, when I'm looking at good credit refinances now, instead of it being 2.75 with a huge credit, it's at par or with a reasonable cost, or even a decent cost, just depending on the exact situation. And it is kind of sad. Like I was helping a client and we were delayed and we didn't pull the trigger back in January, and they were going to be able to do, a $500,000 refinance, and it was going to be actually negative cost at 2.75, which was going to, their monthly payment would go down. They get cash in hand. And the net cost, it wasn't like there was take a year for this to pay for itself. It was actually net negative cost. And that's just gone for that interest rate. Now, I did just talk to a new client today, or actually a couple days ago, and they're at like a 4.5% interest rate. It totally still makes sense for them to do the refinance. The only difference is instead of playing in the like 2.5 to 2.75 refinance range, we're really talking about the 2.5 to 3, maybe to 3.5, depending on how large of a credit they want. But that's what's going on there. And then I know what you guys really want to know is, where do I think the future of this is going? And I don't really have a crystal ball, but here are my thoughts and hopes. So the only real difference between the best pricing and where we are now, which is still good, it's still very good, was, the absolute craziness that happened in the Capitol on the 6th of January. And then also the Democrats taking the 2 Georgia Senate seats, I believe. So there is a fear in the market that the federal government will borrow so much money that the price of these kinds of bonds will go down. That hasn't happened yet. I don't know if it would have that effect even if it does happen. I will say that the reason that mortgage-backed securities are where they are now is because the Fed has promised to buy them all at a pretty high dollar amount. And they've been doing that. And they haven't said they're going to stop doing that. And I don't believe that the new administration's policy on that is likely to change. It's not a zero cost to our long-term future and our financial stability to keep them super low. But I think it would probably be short-term relatively disastrous if the Fed just let go and let the mortgage-backed security prices go to what they want to, because there's probably not going to actually be that much demand for 2% bonds for mortgage-backed securities. There'll probably be a really good appetite for higher interest rate bonds, but the ability of the middle class of America to do a refinance, instantly get some cash in their pocket now, lower their monthly payment, $300-500 a month or whatever. That's probably the realest stimulus plan any of us can actually expect. So I'm hoping that they don't change policies on that. And I don't really see any reason that they would, or any signals that they're going to. So anyways, John Wolf, now at Hometown Lenders, and I have a video about why I moved. If you have any questions, please feel free to give me a ring. Smash that like button. Have an awesome day. Bye.